market. Use the fancy French term, market. And all right, like we said, so up, up, Dow's at 1.6, S&P up 1.3, NASDAQ up 1.2, Russell up 0.4, but we're not hitting our levels, so none of it really matters. But see how the dollar had a huge pullback from just tested 103 and came back to 102.8, so we're looking at a half a point pullback in the dollar that drove this rally, because you can see right here, these are basically 10, 20, and 11. So basically, the market fell. Market started rising first, and then the dollar started coming down. But that's where that swing began, in that area. Could have been somebody said, could have been whatever, who knows. Well, actually, I mean, that's how you find out. Then you go back to the news. News. What am I missing? Go to the main page. Latest news, there you go. Now we go start looking around 10:30 to see if anybody said anything. I didn't catch it. We were looking at oil inventory at the time. And that should not have made it to that. Jinko, so I've seen all these. I read this stuff. Okay, EIA. Nobody cares. I mean, I'm looking at these things and like, that's not going to move it. Nope. Okay, so nothing there. Pending home sales were terrible. Home sales data was terrible. Consumer confidence data, investor confidence data was terrible. Russia losing, blah, 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 don't care. We talked about that. I've seen all these. It's not like I missed them. Ares Capital, Goldman Issues, Alks, Church and Dwight, Chinese EV. Okay, so what's China is pushing the EV, we know that. Spotify in trouble. Investor confidence was worse at 11 something. So I'd have to say it was the European market closing. I'd have to say that was really what it was. It was the European market closing, and a lot of selling pressure must have been coming from over in Europe, and that's then we got that little bounce. Then the dollar. Also, the European market was probably holding up the dollar. People are freaking out of it. Putin said anybody who tries to help Ukraine could be in the nuclear crosshairs. I mean, come on. Clearly not a good thing. So Europe's been selling and running into the dollar because everybody freaks out when you say nuclear in Europe. Over here, we seem not to care, which is weird because we're the only country that's ever actually used nuclear weapons on another country. But we don't take it seriously at all when people threaten it. So I would say that was it. I would say there was a lot of selling pressure coming out of Europe. When those markets closed, then things rebounded a bit. They stopped panicking into the dollar because we're not panicking into the dollar. We already have dollars. So I think that's basically what that was. And again, none of it matters though if it doesn't move the frickin' chart. So what we really care about is, did it affect the 5% bounce charts? And that's here. So did we make it over 43.20 or 13.5 or 19.20? So 43.20, nope, not even close. 13.5, not even close. 19.20, not even close. So it's nothing. There's nothing happening. And I know it's weird when the market goes up 1%, when it goes up and the Nasdaq's up 160 points and whatever, but these are ranges. You have to get used to that these are ranges, and especially in a super choppy, crashy kind of market, you gotta be only saying, are we holding the range? And let's take a bigger picture of the S&P. You know, are we holding the zone at the top, or if we're failing the zone at the top, and that's what this is, you know, including a 20% correction from 48 is what? 20% of 48 is what? It's basically it's almost 1,000 points. So from 48 to 38 is that seems like a lot. 4,800, if I forget the other, times 0.8 is 3840. So all the way down to 3840, which is still a long way down from here, is just a 20% correction zone for the S&P. So are we still in that zone? Well, yeah, clearly we are. The correction that we're looking at here, there you are, 4,800 is the 20% line. So above 4,800, the weak bounce from, so if you assume that we do drop to 4,800, that's an 800 point bounce, okay? I'm sorry, an 800 point drop, and therefore you get 160 point bounces. And so from the presumed 800 point drop to 4,000, you would then get, oh, I'm sorry, and I worked it out the other way. I said 4,000 was the baseline, and that 4,800 was 20% above it. So in other words, if you calculate, you get 3,840 if you take 20% off 4,800, but that's not the way we did it. We did it saying we know 4,000 is a real line on the S&P, so that's the one we use. And then we say 20% above is 48. That's how we predicted 4,800 would be the top, in fact. And back to 4,000 is the retrace. So 4,000 is 800 points above. You come back the 800 points now, but then you focus on the drop, and then you say, well, okay, 800 point drop gives you 100 point bounces, so that's 4,160, and then a second bounce to the strong line is 4,320. All right, so then when you look at the S&P a little bit more zoomed in than that, so we predict, and it hasn't happened yet, we predict falling all the way to 4,000. Okay, but on the way, we're going to hit the bounce line at 4,160, and you can see it coming into play right here, and that's not good, by the way. That doesn't mean it's good. We'll see the bounce here, 4,160 held up, tested again, held up, tested again, held up, but the fact that we keep testing it is not good. And then the next one you got to get to is 4,320, and you can see how 4,320 has failed for the last few days. No, we keep trying to bounce back, but we're not doing it. We're just falling lower. So if today ends up still lower and we start coming below that 4,160 line, and then that becomes a high, that means you're certainly on the path to 4,000. Which frankly, we certainly are anyway. I mean, there's virtually no way we're not going to follow through and correct on this thing. So, we haven't had a proper correction since here, and this wasn't a correction, this was a panic. It's different than a correction. A correction is a repricing with consolidation back at a low. This isn't that at all. This was a V-shaped recovery, meaning that this was some kind of mistake, and we popped right back up here, and we didn't really consolidate. We just sort of tried to move back over. And why? Because stimulus, 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 stimulus. So it's artificial. Look, the economy didn't actually grow. Okay, the government borrowed $11 trillion. The government and the Fed took $11 trillion that they didn't have, and they spent it in 2 years in a $20 trillion economy. So 1/4 of our entire economy over 2 years was stimulus spending. And that's what made it look good. And so now without that, it stands to reason that we could easily pull back 25%. Now let's allow for the fact that there was some actual growth. Although I don't think there was much, but let's say there was some actual growth. So then you're still in the minus 20% range. So that's why I've been saying since the fall, that I thought that we were going to have a 20% correction. That's what these lines are from. And the 20% correction is going to take us back to 4,000. okay, where we should have consolidated properly a long time ago, but it's going to take us back to 4,000, and hopefully that's going to hold up. If it doesn't, though, then the next stop is 20% below, which is back to 3,200, which is where we kind of were here. But now, how likely is it we're going to go to 3,200? Well, to go to 3,200, what are we saying? We're saying that we're worse off now than we were in 2019. And are we? Well, we've got, first of all, we have a lot of inflation since then. So that's going to kind of move the needle up naturally. So let's say it's going to be hard to say that we should be at 30. If we were at 3,300, even if you say we should have corrected back to this line, which is the 3,000 line, where we were, where the 200-day moving average was in 2000. Even if you say that's the correct line, you still have to allow for 10% inflation. So that means 3,300 is more like the base, not 3,000. And then you have to say, was there any growth? Did companies grow? Did earnings get bigger? And the answer is probably yes. Now, so you think about it, who got smaller? Who got permanently smaller? Maybe office space industry got permanently smaller. Something happened and something has changed, and office spaces are no longer the same. The restaurant industry probably suffered losses, but I think a lot of those losses went to different restaurants. So I don't think on the whole restaurants really got killed. Did retail get killed? Not really. People seem to be spending the same amount of money overall. So that's not true. It might have shifted from one place to another, but that's not the same thing as getting killed. The retail industry, you're still buying a pair of jeans. You might not buy it from Levi's, you might buy it from somebody who makes generics on Amazon or something like that, but the bottom line is you're still buying jeans. Cotton is still being used, people are still doing labor, blah, blah, blah. You aren't affecting the worldwide economy much when you buy your jeans. Instead of going to the Gap and picking up your Levi's, you click online and buy your Levi's. It doesn't really affect much except for technically on-store retail spending, but it then increases, of course, online retail spending, and there's not a whole lot of net effect there. So when when we talk about effect, I don't want to, you have to think there's a lot of stuff behind that. When you buy an electric car versus a gas car, what are you doing? Now, here you're making a significant change. When you buy an electric car, you're not buying a huge amount of auto parts. Those are never going to get used by you. Not only won't they get used, but the replacement parts won't get used. So you are killing an industry switching to an electric car. Same amount of people buying cars, more people buying electric cars, auto parts permanently damaged. Okay? Who benefits? Battery people benefit. Battery makers obviously benefit. By a huge amount more batteries are being sold. Charging technology being sold, so on and so forth. What goes down? Electric production goes up. More nuclear plant workers, more nuclear fuel, more solar panels, more windmills. How are we making this electricity? Unfortunately, hopefully not more coal, hopefully not more oil. What, in theory, also with the electric cars, we're going to be now reducing our use of gasoline. Who's that hurting? What about gas stations? Gas stations are actually a very large part of retail sales reports. So not only, and see, here's the funny thing, because gas stations have turned into convenience stores, right? So the total net contribution to the economy of a gas station went up very much because so many people go into the gas station and buy more stuff. So instead of buying just a $50 tank of gas, you buy a $50 tank of gas plus $10, $15 worth of items, coffee, Dunkin' Donuts, so on and so forth. In fact, Dunkin' Donuts, great example of somebody who's going to be hurt by all this. If you have a Tesla, you're going to drive right past that Dunkin' Donuts that you used to stop at to get coffee and donuts on your way to work, because what are you going there for? You don't need gas. And the donuts aren't that great. So you only went there because they had good gas. Not good gas, but they had gas. I mean, it was a place to stop. So when you think about what changed, those are the kind of things you got to think about. Just, travel. Has travel really changed? Are the airlines doing well? Cruise ships still down, tremendously down. That whole industry is tremendously down. If the cruise ships are down, then what happens to other things? Now, interestingly, If cruise ships are down, hotels go up because people are still traveling. They're just not traveling on cruise ships. This is a boom for the airlines right now because people are not taking cruises. Think about how many people take a cruise. Well, that's a good question. Let's ask. How many cruise passengers per year? See, I'm not the only person who ever asked this question. 5.8 million people. Oh, no. Recognized 30, sorry. So they told me that year. All right. So recognized 30 million. That's a big freaking number. So 30 million people take cruises. 30 million. So that's, yeah, okay, confirmed. So how many cruise passengers? Now, how many airline passengers? 4.3 billion. Boy, that's a lot more, right? What do we say, 30 million? That can't be. Wow. What? Total number of passengers carried on scheduled services. What? That's a big number. That doesn't sound right. Passenger air traffic each year. Okay. Yeah. Holy crap. Wow. Okay, so let's go back. Then cruises are inconsequential because it's only 30 million. This is 4,723 million, or here even with the lower amounts, 3,432 million. So just take off the 32, and that's how many people cruises affect the airline industry. It's like it's a 1% effect. Wow. I'm blown away by that. I had absolutely no idea this. Now, that's worldwide, but cruises are worldwide, so I guess we say that's a wash. I never imagined. It's the airline thing I never imagined. 30 million sounds fine for cruises. I didn't think 4.8 billion people could fly on planes. Wow, think about the unused capacity. Think about like a billion empty seats that were flown, a billion empty seats, a billion jobs worth of airline stuff, so on and so forth. So airlines still way down. So like I was saying though, you take those 30 million people, it's inconsequential, but those people are now going to stay in hotels on their trips instead of staying on the cruise ship. They're going to fly in a plane instead of being on the cruise ship. But since airline capacity is down so massively, it makes no difference at all to the airline industry, probably no difference at all to the hotel industry. All right. And the airlines are still projecting a pretty shitty year in 2022, but picking up. And frankly, everybody I know is going somewhere. Everybody I know is taking a vacation. I have a conference in Vegas I got to go to next week, in fact. Can't believe it's already, I can't believe it's already coming up. It's like so crazy. I'm speaking at a conference in Las Vegas. When is it? Friday, Saturday, something like that. Las Vegas Finance Conference. La la la. Fundamentals of Finance. That's not what it's called. SF Vegas. Money Show. Nope, not the Money Show. Oh, for God's sake. Las Vegas Finance Conference. Nope, hit the wrong button. International Conference. I don't even know what the heck I'm talking about. Envy Finance? That doesn't sound right. Finwit, that was it. See? right? May 13th, oh, May 13th, 14th of the area. That's it. I'm talking on the 14th. I have no idea what I'm talking about. I don't know what they want me for, but I'm going out there. I agreed to do that. That's it. FinWit conference hosted by Ben Ziegler and whoever is Luton Capital. This. Anyway, so I'm getting in a plane. Am I up here? Where am I? Oh, there I am. See, Phil Davis. A lot of guys. Ugh, I hate that. Oh, wow. A lot of speakers. I don't feel special at all. Take 2 days to invest in yourself, get tickets, blah, blah, blah. Tickets are like $400, $500. So anyway, so yeah, no knock on them. It's probably my fault, but I have absolutely no idea what I'm going out there for or what I'm saying. But hopefully over the next week I will figure it out. They've not been focused on this thing, and all of a sudden it's already like the end of April, which is crazy. All right, where were we? We were talking about something else. I forgot. Wednesday. We're talking about our levels. Traveling. Oh, yes, right. I was talking about, that's right. I was talking about how you have to think about the overall effect of the market. So all this stuff, as I say, there's things that took a hit, but now how big of a part of the industry is the airline industry? What does it contribute to GDP? What are the factors, so on and so forth? Anyway, so given inflation, given especially energy inflation, given the differences of the pluses and minuses of the lockdown and how it's changed our habits and so on and so forth, it doesn't seem like we should have gone too far back. So certainly 3,000 seems not really possible. And this is really key, okay? So 3,000 doesn't seem like it's very likely. We were at 3,000 in 2019. We've had inflation we've had 2 years of inflation now, and then certainly big year this year. So that's good, let's say, for 15% by the end of this year. And we're talking about, so then we're going from 3,000 to 3,500 at least. Then you say, have we grown? And you say, well, we certainly haven't, I don't think we've gone backwards. So if we're at 35, I would say somewhere in this 38, 4,000 range is probably the right place at this point. All right, maybe it's a little much, maybe, because you got to think this had so much stimulus in it, we really wouldn't have done that well. But are we back on our feet? Because you can go to the hospital and you can get a blood transfusion, and we can take the blood, we can stop giving you a blood transfusion, you can walk out of the hospital and be fine, right? Right back to where you were before you went in the hospital. So you can't just knee-jerk say we can't function without stimulus. We could be fine. We can go right back on our feet, and right back on our feet means keep in mind, right back on our feet means we're back on this path to 4,000 or 5,000. In fact, some analyst today just said, I think it was like Bank of America, but somebody just said they predict 5,000 at the end of this year. Those people are idiots, but that's beside the point. But they're saying that's their trend. You watch the S&P trend and you say, well, we should be at 5,000. If things hadn't gone screwed up, probably would be at 5,000. So, but they did get screwed up. You have to acknowledge that. Okay, so the same thing, if you had your leg amputated in the hospital and you come out, nobody should be expecting you to run the 4-minute mile. Okay, it's not very likely you're going to pull that off with the one leg. It's just a fact that things have changed. So we have lost traction. This isn't a temporary setback. This is a lost couple of years of fairly flat, struggling economic growth where the market was propped up by stimulus is the best way to say it. So rather than drifting along flat at 34, 32, 36 in this range, so let's say 34, rather than drifting along at 34, we had a lot of stimulus. How much stimulus? 25% of our total economy. And then we could back test that too and say, okay, well, if 4,500 was 25% more than it should have been, then it was basically 1,000 more than it should have been. right? Because that'd be 25% of 4,500, which means 4,500 times 0.75 is 30. I went back to all roads lead us back to 3,400. So 3,400 plus 15% inflation, $39.10. So you know, basically, I agree with that. That's sensible in many ways to slice it and come up with that number. I would say generally that's correct, and that does bring us to roughly a P closer to in the low 20s or maybe even 20 on the S&P 500. So that is what I think the base would be. Now, it's possible we don't get there just because, so if that's your worst case, and your worst case can be violated, and then you come back like this, you know, your worst case can be violated, and then you bounce back. Doesn't mean it's not your worst case, but it also doesn't mean you should go crazy betting on the worst case holding up. But if that's our worst case, if we do break down and hit 4,000, at that point, there's very little risk left, right? We don't see a lot more risk that we're going to be buying like crazy if we can get down there, because we think the rest would be panic. But again, this is pending because this is, again, this is what the news is for. Why are people getting punished for earnings? What did they do wrong? What went right? And we're only just learning now, okay? Because there's you know, thousands of companies to report. We're only getting this week maybe 500 companies reporting. We're only getting the first beginnings of a view of what's going on in the industry. So who is having something interesting? So iron ore comes up as China lifts some COVID restrictions on iron ore. That was beaten up and coming back. That's fine. Facebook. Okay. Facebook drops on erroneous guidance release. Facebook saw a sudden slide after erroneous guidance outlook for the company spread minutes ago ahead of its earnings. People jumping in thinking they got advanced information. All right, whatever. So don't worry about that. Apple is playing with mixed reality. General Motors gets a buy rating after strong earnings. So GM had strong earnings. That's interesting because we have Ford as an investment. Why did GM have strong earnings? They boosted their guidance. They had a strong Q1 earnings beat. Interesting. So they're dealing with their crap. They're dealing with their supply chain issues and everything else. Is GM much smarter than Ford? Are they a much better company? I don't think so. I think that probably we should see both doing okay. Molecular Partners, Eurogen, Visa. Okay, now Visa had wonderful results. Why do they have wonderful results? Because people are using their credit cards to finance things that they can't afford. We talked about it yesterday, how we have a severe knockdown in discretionary income. People don't have any money because all the necessities that are inflating on them are eating up all of their cash. So they're turning to their credit cards as a theoretically short-term solution, but that's the problem because the government keeps telling people that inflation is transitory, right? It's not going to last, and everybody, I mean, keep getting hammered with that, right? Oh, the inflation's run its course, it's getting better, blah blah blah. Now we heard this for freaking 10 years, you know, starting with Jerry Ford putting on a whip inflation now button, and all the way through Carter's administration, right? So it's Ford for 2 years. He had a whip inflation now button when he first came in. That was his first campaign promise as Nixon was resigning. So that was 73 or 74, 70, let's say 74. Then 76, Carter got elected, and Carter was just, you know, he just bit the bullet on inflation. They blamed him for it, even though he had nothing to do with it. And then Reagan came in, and all we cared about was the Iran hostage crisis, and then he had that fake war in Grenada, which was really insane. And that distracted you from the arms for hostages crap that he was doing, that he did because he wanted to, you know, be the big shot and free the hostages in Iran. So he made that deal that was completely illegal. and Reagan didn't. Well, he did kind of. I mean, the inflation broke its back, but it wasn't so much Reagan as it was Volcker. Volcker came in and started raising the rates, and that knocked inflation down finally. But we're all the way into like what I say. So from 73, Nixon inflation started around 72 under Nixon. Then Ford came in to 74, 76. Then it's 80 for Carter. And then Reagan came in 80, and you're all the way out to like 1984 or past 1984, almost into the savings and loan crisis that came in 1987 under, was Bush in by then, or is it still Reagan? I think it was still Reagan at that point. Because Bush Sr. got elected, but I think by then we had the savings and loan crisis and everything was falling apart, and that caused a recession. So we had a solid run of 8 to 12 years of inflation that was completely out of control, and the whole time it was the same bullshit, which is why I'm so skeptical, I guess, is having lived through that at the time. I mean, it just tell you all the time, oh no, this inflation can't keep going like this. Oh no, and it would just go higher and higher and higher and higher, and it was just freaking incredible. I mean, you literally were buying a mortgage for 15%. You're also getting 15% on your savings bonds, so that was great. But what was not great about that, though, was that they would tell us that this was how we would retire, is we would put this little tiny amount of money in the bank and we get 15% a year for 40 years and we'd all be millionaires. Well, that of course was bullshit because it didn't last. So anyway, bottom line is, though, this is just another cycle where the credit cards are going to do good because everybody's maxing out their credit cards to try to keep up with their grocery bills. That's what's happening. So there's nothing, so the Visa thing is benefiting from here. Caterpillar, I guess we'll see later, right? Because that's tomorrow, not even later. Yeah, but you would think Caterpillar would be doing good though, because the infrastructure. Who's exciting here? NCR to me was very surprising. They got killed. You wouldn't think NCR's business would suffer so much, but they really got massacred. Aluminum prices rebounding because China's infrastructure push. So all of a sudden, metals, aluminum, so on and so forth are going up. Mattel had a good pop. MSC Gaming is doing good. What you're kind of looking for, you got to look for trends. Hess is like kind of a refinery, but oil company refinery, so on and so forth. So they obviously kind of hard to say, how could they not do well at these prices? Airbnb doesn't, that's just a thing about what they're doing in Europe. What do they lose a legal battle on? They objected to having to provide tax information. That was never gonna work. It says latest blow, albeit minor. Yeah, it says who cares? It's like a reporting requirement. T-Mobile on subscriber growth. That's interesting. Duke Energy, NCR. What did they do? Virus disruption, Russia-Ukraine war, cost inflation. Costs are up and they haven't been able to pass them on. That's basically the bottom line for guys like that. Genco Shipping, don't care. Investco, don't care what they do. Amazon earnings coming up, of course, is huge. So what we're trying to do is kind of get an idea of like what's winning, what's working, and what's not working in these companies. Bank of America sees 3 straight 50-point rate hikes. But he doesn't see a recession. Okay. Yeah, the Fed knows what they're doing, blah, blah, blah. I hate these people who think that like everything is magical. Oh, somebody else picked up Bitcoin as a currency. The Central African Republic. That's a place? Yeah, okay. All right. Can anybody point to this on a map? The Central African Republic. See, now I gotta know. Where is the central, see, nervous system? Oh, there it is. It's on the list. Wow, okay. Oh, it's in the middle of Africa. You know what? I guess if we were on Jeopardy, we should have figured that out, right? Like, well, it's in the middle of Africa. It is really central. Oh, wow. Okay. So who are you guys? That's interesting. So under Chad, over DRC, Cameroon, love Cameroon, Central African Republic. Nope. Look, restaurants and hotels. Oh, no. Wait, I want to know that. Yeah. Wiki. Landlocked Central Africa, blah, blah, blah. Covers land. 4.7 million people. Established by France, 19th century. I'm sorry, that's a baffler to me. I guess just because of the name, I never really thought about that being a place. So it bothered me. It was bothering me. It's a place. All right. What are we talking about? Other news. Okay, so that's enough of that. So the gist of it is that's what we got to do. We got to keep reading the news and try to make a little checklist and say, here's what's working, here's what's not working. And then a week from now, 2 weeks from now, we'll say, oh, well, they're in this industry and therefore this and therefore that. And then we can make some better guesses as to what the earnings are going to look like for these companies. Right now, we don't know. Let them tell us. Don't guess. And I find, frankly, it's detrimental to try to guess, because if you guess, you start like making assumptions, and then it's hard to get those assumptions out of your head. It's better if you have no expectations and you just let them tell you what happened. You know, let the CEOs say it. Let them give their reports. Let them say, this is what happened to us. We had this, we had that. The supply chain, this, the couldn't pass on costs, currency issues, blah blah blah. Whatever it is, let them tell you what happened in their business, so that we can then figure out. You know, then we start to understand what that business is like. That's how my brain works anyway. It's like I want to understand their business and their business challenges, so that we can see the competitors will become clearer to us, because we'll say, oh, that's like this, and oh, that's like that. It makes more sense. And so later on, 2 weeks from now, when we talk about ones, we'll be able to say, oh yeah, of course, because Alcoa did this, and Vail did that, and this, and Rio did that, and we'll know what everybody said in a sector. So then we'll say, well, it's highly unlikely that they escaped it. Like yesterday, I was right about Google. I said I think Google. I can't see how. Who was it? Somebody. It wasn't Facebook, was it? Oh my God, I'm totally blank. Somebody with a lot of advertising revenue. Oh, it was Netflix with subscriber growth, right? So I said Netflix is telling you they had a really hard time growing their subscriber base. And then even, Google is, see, there you go, it's similarity. So I said Google is not likely to have done well, because you have to imagine that their YouTube subscriber base shrank with Netflix's subscriber base. And if the total amount of online viewing or watching or Googling went down compared to the pandemic, where everybody was stuck at home, which of course it would have to, then where's Google going to be making up the advertising revenue? Was there a boom in business during this time? No, we didn't have a very strong quarter for business in general. So therefore, I don't see the pluses outweighing the minuses. Therefore, Google was probably going to be weak. They were, but not very, because it's Google. They got a monopoly on the world. And I'll tell you some other thing. 5 billion. We just hit the 5 billion mark of how many people are on the internet. 5 billion people in the world out of 8, which is, I don't know. Oh my God, where's my brain? 50%, 4 billion would be 50%, so it's got to be 50%, about 65, about 2/3. So, or is it 60%? 60%. So 60% of the people on the planet are connected to the internet. That's freaking amazing. That's way up. So now for Google, see, here's the interesting thing. That's beneficial to Google because Google doesn't need you to be rich. Google sells eyeballs, and of course, obviously, somewhere if you granulate what they're doing, it's better to have rich eyeballs than poor eyeballs. But we're not adding rich eyeballs to the internet. We're adding poor eyeballs to the internet. But even poor eyeballs is a big benefit for Google. And since Google is effectively a monopoly and pretty much everybody who's on the internet ends up using Google, any growth is good news for them. And the number of people plugging into the internet hitting 5 billion is huge. Now, that may have been boosted by COVID and it may backslash, but I see it a little differently though, because I don't think anybody who's gotten connected is going to say, I don't want to be connected to the internet anymore. It's different to be connected than to just increase your usage. So I think having those new people on and growing to this level at this point is a very good sign for Google and their growth in the future, because they really just care about more people for the most part. More people is more money for Google. Now, Amazon's getting interesting because Amazon, other companies have just given up and they're letting Amazon now deliver their stuff. So Amazon has now become the delivery company for so many different retailers. Doesn't matter who you order from, Amazon's going to deliver it to you because they've got the logistics down. They really won that battle. And UPS should be very nervous about it, although UPS still has very good numbers because Amazon primarily uses UPS. But one day, Amazon's going to tell UPS, no, thank you, we got this. So that's interesting what's going on in the background. And so that's probably another one where if they go lower, it might become interesting to buy. Although I mean, Amazon's multiple is still pretty insane, but not like it used to be. It used to be 100-something times earnings. Now it's probably less than 100, probably 50. Let's see where we are. Is this it? Yep. Place your bets. I say 50. $1.4 trillion in market cap. That's a good start. Because they come down quite a bit, and that's against. Ooh, well, that's not fair. Okay, so gotta take my lumps. Okay, so it's $1,400 billion divided by 24.6, 57. All right, so it's 57 times earnings. But if you look ahead a little bit, realistically, I think I'm going to take credit for being pretty much in there because at some point they're improving it to below 50. So as you guys know, Amazon was my shorting white whale for one thing. I used to always want to short them, and then I would always get burned because they kept going up, even though, from here, even though they were trading at hundreds of times earnings, they kept going up and going up and going up, and it was driving me crazy. And then this happened, and I tried shorting them, and it never really worked out. This is going back to 2020. It drives me nuts because the multiple times earnings here was ridiculous, but now they've rapidly grown into it. The money has been pouring in lately, So they went from, you know, here in 2017, this is my point. In 2017, they were at $1,000, and they're currently at what, 2,700, right? So at $1,000, they were making, which, well, 1,000 is what, 1/3. So let's say, not 6, 5, you know, basically 500 billion in market cap, and they were only making $3 billion frickin' dollars. That was really annoying. But then they cut spending and so on and so forth, and they got to 232, and but they didn't stay at 500 billion, because in 2018 they popped to 1.7, 1,700. So they almost doubled up to $1 trillion. And still I objected, because this is 100 times earnings, and we're still at 100 times earnings, and 100 even here 2020. They were up at 26, so still 100 times earnings. Finally, in 2021, they had this nice pop, and they dropped below 50 for a while. Now they're back to a bit over 50, but you know, I don't disagree with this trend. I think they're going to be up around $35 billion in earnings, and that makes 1.4 trillion not terrible, not with that kind of growth. So don't love them, but don't hate them. Used to hate them, don't hate them anymore. I mean, you got to say this is a phenomenal company, and taking over the backbone logistics for other companies is huge. But when you're the size of Amazon, this is the problem with all these big companies now. When you're the size of Amazon, even if you gain the entire market cap of UPS, okay, UPS is $159 billion. That barely moves the needle. That's a 10% gain to Amazon's total price. So if Amazon took over all of UPS's business and made all of UPS's money, it's really not enough to move the needle on what they've got. UPS trades at just 10 times earnings, or not, sorry, 15 times earnings. You know, which is, you know, interesting. But they do face a lot of pressure from Amazon. There's going to be a big problem for them going forward. It's huge competition in shipping. And oh my God, have you guys seen shipping rates? Out of control. SK says stock split is coming for Amazon. What would, if it's just a split, it doesn't really impact anything. Web services is huge for them, right? That's true. You know, yes, Amazon has other things, but I'm saying the point is, how do you grow when you're that large? You know, Apple is a $2 trillion company now. So what are they going to do to get 10% bigger? What $200 billion thing are they going to come up with? Now, frankly, in Apple, I think that you will get, I think the same way you get Apple phones or Android phones, I think you'll get Apple cars or Android cars, and later on we're going to have Apple homes or Android homes. I frankly think Apple's going to kick their asses on all those things. Although I got to tell you, the new Google ads that for their phone for Android are showing a lot of cool features. They're pushing really hard in this cycle to fight to try to get their market share back from Apple, but they kind of have to, because Apple has just really taken over. I mean, they've dominated. Somebody big stopped making phones. I forget who it was, but somebody well known gave up on the phone market because they just can't compete. And you know, Google is subsidizing the Android market because they can't really compete. It's like when the iPod came out. You know, Apple just kept grinding everybody down into dust, and people kept trying to compete and come out with something better. But then there was, you know, it ended up being not as good, and they would spend all this money, and you know, just couldn't beat Apple. So there's no point. And it's not the gadgets of the phone so much as it is the cost, because what happens is Tim Cook was the guy behind the iPod in the first place. Tim Cook is a wonderful supply chain guy, which is why I really strongly favor Apple right now. Tim Cook is an amazing supply chain manager. That was his job with the iPod, he was their supply chain guru. And he is amazing at getting everything to the factory, at getting stuff ordered, making sure he's got his supplies lined up, getting the best prices, so on and so forth. He is the best at getting costs down and profits up. And it doesn't matter if you really improve it, because honestly, what did they do to improve the iPod other than make a teeny one and a thin one and a fat one and blah blah blah? It's just flavors. But he got those prices down to the point where it was just ridiculous, right? Those little teeny iPod minis were so cheap in neon colors, remember? And they were so cheap that people would buy different colored ones because it was like, what are they, $50 each or something like that? So for $50 each, I want a red one and a blue one and a green one. People wanted ones that match their outfits, not guys usually, but girls. And people just wear them like badges and stuff like that. They totally took it over. They still have the high-end ones too, but people, they had every level covered, so there was really no room for competitors to come in anymore. And I think they're moving that way with the phones. They just haven't come out with the phone mini yet. But I'm pretty sure that if you think about it, they could just have a low feature phone and maybe slightly lower resolution or something like that. Frankly, I'd buy that. I would buy if they could make a half-size iPhone, that would just do the basic stuff like call and text and so on and so forth. I'd be thrilled. I really don't need all this crap in my pocket all the time. But anyway, so the point is, I see Apple with some real growth because $2.5 trillion, the crazy amount of money. $2.5 trillion is a lot of money, but if you think about the concept of there's 200 million cars in this country, and they have Apple Play in the cars, but think about it more of an Apple integrated audio system where your iPhone controls your car functions, and also Ubers. When you get into an Uber, it'll configure itself to your preferences, and especially when they're self-driving. But the car will configure because you're calling on your phone communicates to the car, and it sets it the way you like it before you even get in the car. Your music, your temperature, so on and so forth. Especially when we start having self-driving cars, you're going to really want that, right? You don't want to have a self-driving car pick you up, and every time you got to sit there and fiddle with it until it's the way you want it. You want a self-driving car to pick you up and be playing your music and have your environment set up and have the seats the way you like them and so on and so forth. Why should you have to do any of that stuff? It knows it's picking you up. So, they're going to integrate Apple into these car environments, and the same thing for houses and the same thing for hotels. When you go to a hotel, it's going to be set up the way you like it because your phone's telling the hotel room what your preferences are. So, we're talking about a massive market of in the future of these things. And these are big ticket items, integrating the home, built-in audio systems, the television, so on and so forth. It's huge, and there are so many cars and users and so on and so forth. And of course, down the road, there'll be robots. So there's going to be a lot of stuff for Apple to get into, and they'll still be in their core space of the electronics. It's not like they're going into crazy stuff that has nothing to do with Apple. This is all still in their core competency list before they go anywhere else. So I'm not worried about Apple's long-term growth. I think they'll just steadily move up and become a $4 or $5 trillion company over time. And again, not in a direct line. It fits and starts. You have to do your R&D. I don't think Tim Cook is going to be the guy to do it. I think that the next person coming in is going to be the one who goes for the bigger stuff. Because it'll be a lot of R&D, a lot of research work, a lot of hit and miss. You're going to need they're going to have to pick somebody who's willing to, swing for the fences and hopefully not miss. We shall see. Anyway, earnings, looking for stuff, so on and so forth. Right. So let's talk about some hedges. What to do to log out? Oh, that's clearly not working. Hello. How are we doing? Hey, not crashing. Great. Okay. So the short-term portfolio is now up 237%. So that's close to 700,000. But I guarantee the long-term portfolio is not looking as good. Yuck. Okay, so 286, I already know it's bad. 1.9. So 1.9 plus 7 is 2.6. So we're down like $400,000 at the moment. A lot of that is because the VIX is so high, so we're getting punished. But also we've got legitimate problems with some of these positions. And I don't want to get into the whole thing, but we have, Boeing is down. We're going to put more money into Boeing. BNTX is down. We have to pick. We can't like support every biotech that's down. We have to pick a couple and stick with those because we have some very big biotech plays that are down. Facebook is a bit weak, but we're just going to, that was an entry position, so we're happy to add to that one. Leibu is a biotech ETF. Moderna, it's all biotech. Biotech's killing us. Moderna also very, very, very down. And by the way, I think this is really silly. First of all, China is very interested in buying all the vaccines we don't want. We just haven't been willing to sell it to them yet. So they're not going to be hurting for customers. Pfizer took a hit. Come on. This is a little silly at this point. Pfizer isn't even that dependent on the vaccine. Of course, it's a big boost, but Pfizer's got plenty of ways to make money. Oh, what the heck is that? Let's try it again. PFE. There you go. So Pfizer took a hit, but only a pullback from here. It was crazy high at 60, and it came back to 49. We bought back the short calls, but now let's see. We have the $50 calls long, and Pfizer's at 50. They're down about 50% right now, so it would be smart of us. So we're going to either roll into a lower strike, we might roll into the 40s, or just double down where we are. All right, or do both maybe. So let's think about that. We have we have $26,000 worth of Pfizer, and keep in mind we already brought back the short calls for nice profits. So we're not down anywhere near this much, but we had $26,000 worth of Pfizer stock, and if we were to, those are the 50s, right? So the 202 450s are, yeah, like 675. If we roll into the 40s, the 40s are almost 12 bucks. So it'll cost us $5.50 to roll to the 40s. That's definitely attractive because the 40s are in the money. They're $10 in the money, so that's worth it. I'm going to pay $5.50 to roll down $10. Or, and like I said, or double, or both. So if we sell, do we want to sell the? I don't want to sell the 50s. If we sell the 55s, let's say for $5. Now, so let's say we sell 2 times total coverage of the 55s. That will raise $10, right? It'll cost us $5.50 to roll it, and then 10 to double down. So effectively, it'll cost us net $5.50 in order to be in double. So let's see what that works out to on the page. So we can take this spread here, and we can go from 40 of the 50 calls to 80 of the 40 calls. I'm not really, of the 40 55 spread. So 80 times 1,500. So that becomes $120,000 spread, and it'll cost us double this. We have to pay another. We have to basically pay the cost of 40 more. So that's 26,500. So it's going to cost us. We spent 52 already. We're going to spend another 26. So minus 52,000 minus 26,000. So that leaves us with $42,000 of upside at 55. Now we're at 50 now though, so that's pretty reasonable. And then we can look at selling, since we have 80 longs, we can sell 20 short calls, right? And if we can sell 20 short calls, the June, well, they're not very far away, but let's see. The June 55s are not even $1, so we wouldn't do that. The September 55, there you go, 160. So September 55s for 160. And we sell 20 of those is obviously $3,200. So we have whatever, 60,000 or so invested in the spread, or 80,000. Let's say we have $80,000 invested in the spread, and we're selling 3,200 using 142 days, so about a quarter of our time. So probably we can pull about $12,000 more out of selling short calls while we wait. And that means we have a $52,000 upside. And currently, we are, so we would have a in fact, that's how much we have now. We would have a $52,000 upside at 55. If this gets to 55, we're not even going to be break even. We'd be at $20,000 total out of 52 spent. So we change what would be $20,000, a net $32,000 loss, to a $52,000 potential profit by spending $26,000 more dollars, and we put ourselves in a much better position overall. And of course, I'm doing that math based on doing a quarter sale of the short calls. Therefore, if Pfizer got in trouble, we could sell more short calls, and of course, we can always roll and go for a lower strike and so on and so forth. So at this point, there's too many positives not to do that, so that's something we will be doing. Got to be careful though, because we have $1.7 million in cash to spend, so that's not terrible. But you can't do it on every position. So that's why I said we're going to have to pick a biotech, probably Moderna, that we want to really stick with and press, and we're going to have to probably give up on some of the other biotechs, because you just got to pick a horse and go with it. You can't sit there and say hit every one and say let's hope one of them pays off if we keep spending money. So Moderna, same kind of thing. They're at 140, we're at 150. We probably roll down and double, and that's going to be spending $86,000 more dollars, or $100,000 more dollars, or whatever it works out to. And we've already got the short puts, so we'll do that, and then we'll probably pick a cover, and we'll leave ourselves upside. And what we want to do is have a good, considering we're going to be closing these other ones, we're going to want a good look at Lebu. It's going to be $50,000 loss here. Biontech has got to be terrible. $70,000 loss here. So we got $120,000 in loss on those two. So we have to take that and turn that into something on Moderna that we feel is going to actually make money. All right. So then again, I'm not for sure saying we're going to do Moderna, but conceptually. But we'll push Moderna, we'll push Pfizer. That's how we're going to try to get our biotech money back, and hopefully it pays off. And that's how we're going to go through this. We're going to go, in the next review, we're going to go through these things. Oh, I hope I'm not in Vegas, because that'd be a mess. Let's see. I'm in Vegas here until here this Friday. Oh no, I'll be back. Okay, fortunately, I'll be terrible. I'm going to probably arrive like 5 in the morning or 6 in the morning on Monday back home. So I'm going to be almost certainly out of contention on Monday, but the rest of the week we got to do all of our portfolio reviews and figure out where we are. But at least we'll have like plenty of earnings information by then to work on. I think what I have to do though is start doing some of these adjustments now, especially if they're advantageous timing. AT&T, right? Now that we saw the split and so on and so forth, we're gonna have to adjust that one. TD Bank, Vail's doing good. It really is the biotechs. If it wasn't for the biotechs, we'd be doing great. So we took the hit on the biotechs, that's fine. And like I said, though, it's mitigated by the fact that we added a lot of money to the short-term portfolio. I mean, we went over the short-term portfolio yesterday. We still have about $1.6 million worth of upside protection, even even though this went up well over $100,000 now from the last time we did an adjustment. So we're in good shape. We've got cash now because we adjusted a position on the SQQQs, which we sent out a thing for yesterday in the mail. And I think it's well protected. We got Lebu now. And we didn't take a big hit on that, but that's just annoying to see that. Look at W. Wow. Oh my God, they're collapsing, huh? That sucks. We shorted them. This was a leftover piece of the short, and we thought they were going to bounce back, but they just get worse and worse and worse. Look at that. It's like they're going bankrupt. You know, it's kind of at the point where it doesn't make sense to do anything about it. It's wiping out all the gains we had though from the short position, unfortunately. The 150 puts us $75. The reason I didn't want to roll it was because I don't really want them. We don't like them. It's not like we think they're good. We don't think they're worth anything, but they're worth more than this. So it's okay if we have the 150 puts and they're $75. Not these, they're 2023s. So we have the 2023 150s, they're 75. But you see, we can get 35 for the 90s. And so it doesn't make sense not to do that roll, right? We're just going to roll to 2 times the 90s. And our obligation isn't really going to be much different. You know, because what we have now is 10 short 10 short 150s we sold for, well, let's say it was 25. We sold them for 25, so it's our base is 125, so $125,000 is a commitment here. Okay, let's keep that number in mind. And if we went to 2 of the 90s, and that's 70 versus 75, we're going to lose $5,000. And what did we collect? 25 at the beginning, or 20, about $25. So we collected $25. That gets taken, we'll take the 5 off, so it's 20, so it's 10. So our net is 80. If it gets assigned, no, I'm sorry, not 80, 85. Our net would be 85 if no, $10, sorry, 10 below 90. Our net would be on 20 would be 80, so it's 160,000. So all we're doing risk-wise by rolling from the 150s to the 90s is our assignment, if we get assigned, goes from 125,000 net to 160,000 net. And it's, you know, so all of this stupid thing has to do is stay better than 90 or get better than 90, and we're all good. But now we have to sit there and stare at the stupid thing for another 2 years. But that's a passive move I don't mind making, right? Because it's only putting $35,000 more at risk. And again, we don't think Wayfair is going to go bust. You know, it's not like you know, it's just going back to it. It's back at a price that makes sense for them. You know, the pandemic's over and people are going to go back to buying furniture like normal people. That was our shorting premise in the first place. But now they're getting priced like nobody's going to buy furniture at all. So here's Wayfair. And again, I don't like them. It's not a company I like at all. They're $8 billion. They make no money. All right. So you're just betting on their future potential. But before this all happened, people were, people were happy back here, all right, in 2018, people were paying $100 for this stupid thing. In 2018, when they were losing $500 million. In 2019, they lost $1 billion. All right. And then the pandemic came along and they were doing fantastic, but they weren't even making money. They just were growing revenues. Now, the thing is, they're still growing revenues. This is a huge boost to their model. So, people are bailing on them, but the bottom line is the sales are there, and now they've got to tighten up the internals and start turning this into cash and make money. And don't forget, they're being killed by supply chain issues. They're completely wrecking their business because most furniture comes from overseas, and it's a big problem for them distributing the furniture. So everything's tied up in the ports, everything takes too long, so on and so forth. But traditional furniture stores aren't going to be doing any better. They also have no supply, no inventory, so on and so forth. So don't count these guys out completely. They are executing their plan, but they're executing their plan the way Amazon executed their plan. Like, hey, we're growing sales, but we're still losing money. And the question is, can they keep their investors happy with that story? How's their debt? Not much, 653 million in debt. So they're not terribly in debt. They've got 2 billion in cash. So they're certainly able to service that. That's net debt though, is 653. So they've got 2 billion in cash. The net debt is 653. So they've obviously got 3 billion in debt. But that's, again, not terrible. It's doable. And of course, it's if you look at the cash that they have now, they'll be able to service it and move it forward. So they shouldn't be in too big a trouble. But again, the furniture business, when you are buying furniture from China or wherever they're buying the furniture from, and you have to wait 2 months for it to be delivered, you're probably paying FOB China, freight on board China. So when it leaves the dock at China, you probably have to write them a check, and then you're sitting on inventory for 2 months while you wait for it to get through customs and finally make it to port over here. And then you have to transport it around the United States and ship it and so on and so forth using movers. And we all know how much movers are awful. So you can just imagine a logistics nightmare of a company like this. But again, it's no different because every furniture company you go to is basically just a showroom. And all they do is show you what you're going to get online. Wayfair is skipping that part of it for the most part. But technically what they do is they encourage you to go look at other people's showrooms and then buy from them because they don't waste their money on showrooms and they can sell you cheaper furniture. The problem is that they've got the real problem with Wayfair. And again, I was short on these guys, so it's a whole different problem. But the real problem with Wayfair is that they have terrible quality control because they treat it. The problem is they envision furniture like it was merchandise that was in a box and they would ship it and so on and so forth. And maybe there'll be some damage. That's not how furniture works. Furniture is really big, heavy, bulky, hard to protect in shipping and so on and so forth. So it often gets damaged in shipping. And furniture companies have people on staff whose job is to fix the furniture before they give it to you, to test it and make sure all the screws are tightened and so on and so forth. That is not something Wayfair really does. So they end up delivering a lot of furniture that's in totally messed up condition. And that means that their returns are what's killing them on the bottom line. And again, these were all the reasons we shorted them, but they're also things that will theoretically be worked out if these guys can be smart enough to manage to do that before they run out of money. And again, don't love them, don't want to give them the time, would much rather be out of it, but unfortunately, we have taken such a severe loss on this stupid put that I don't feel like taking the loss. It's too silly because we can just roll out to the 90s. Instead of, I don't have to wait for them to come back to 150. If I had to wait for them to come 150, I'd pull the plug, but I think they can get back to 90. I don't think they can double, but I think they can go up 20%. So I want to give them that chance. And so therefore, we're going to stick with this, and I got to stare at this stupid thing for another 2 years waiting for it to to work its way through. Very annoying. Okay, so that's the story on that one. But meanwhile, it's not hindering the overall portfolio because we have 1.6 million of shorts down here. And as long as they're kind of reflecting the market weakness, we'll be all right. But that's a shame. I mean, we were down 20,000 when we cashed out the spread, and then we made tons of money on the spread, and we were hoping it would bounce from 20, but instead it's gotten way, way worse. But that was just a chance we took, and we thought it would work out, but we just ran into a really big downturn in the overall thing. Now I always like to look at Money Talk to see how we're doing, because Money Talk we don't touch, and it gives you kind of a barometer. And not too bad. I mean, we were, I think, 140. We were at 140 for a while, but 133 is fine. Not getting hit too severely. They also have Lebu. It's also killing that portfolio is Lebu as usual. We don't have Pfizer. I thought we had Pfizer. But this is our no-touch portfolio. I imagine in May they're going to want me on the show again. I have no idea when. I guess I have to talk to her about that and find out when I'm supposed to be on the show. Maybe I'll do it from Vegas. We'll see. Robin says, any thoughts on when to add mortgage companies like the REITs, the mortgage, like TWO? And she says she has an internal position. The thing about the REITs is right now everybody's very nervous that interest rates are going to hurt them, rising rates, and it depends on how the company really runs their portfolio. So you can't generalize them. You have to really look at like the company and how their portfolio is distributed and what they do for assets. TWO's debt is $7.7 billion. That's quite a lot of debt. And that's rising, the rates. Notice they saw this coming though, and this is why I like them. They saw it coming. They used to have a ton of debt. They've reduced their debt tremendously in the past year. But how have they done that? They've done that by selling off properties. Look at now they were bringing in this huge amount of revenue. See, this is a loss they took. They took this loss selling off properties and raising cash to knock down this debt. But now they have a lot less property, so they only anticipate having 400 million in revenues. But they expect to make 187 million. Here it's interesting because here I imagine they're selling off other properties and they expect to make 283 and 283. So they've got plans to sell more properties off for profit. They sold off all their unprofitable properties, and they took a huge hit, but that huge hit gives them carry forward tax losses to offset, so on and so forth. So they know what they're doing. I mean, they believe me, it's all about the gaming of the books and so on and so forth with these companies. The question is, what is really left in their portfolio and how long can they sustain this? And keep in mind that you're paying $1.6 billion. Now, paying $1.6 billion for 200 million in earnings is not bad. That's only 8 times, it's a PE of 8. But is it sustainable 8? Will they last 8 years doing that? Because they have sold off a huge amount of their portfolio, and they're probably using a lot of that money to service their debt. But if you look at the debt, if the debt is $7 billion, and rates are going up 2% this year, 2.5%, so $7 billion times 0.025 is $175 million. That's going to kind of wipe out most of their profit. So, you got to be careful about these companies and look at what their debt is, and then we have to find out what do they plan to do with it. So the earnings reports for these guys, I mean, what you want to do is wait till we have the earnings report and ask me what we want to do about them. But that's a little scary. Let's see what NOI is doing. Now, NOI, see, this is the thing. NOI went the other way. They bought a bunch of stuff. So they've increased their portfolio. They decreased their debt, though. Good job. But look at that freaking debt, $60 billion of debt. All right, fixed assets. So fixed assets, well, actually went down. So fixed assets went down. Interesting. They seem to have moved into things that like produce more income for them. Now, with NLY for $10 billion, you're getting real earnings. You're getting $1 billion drop to the bottom line here. Makes a lot more sense. But again, the scary shit is this: it's 60 billion. That means they're going to have 100 and I'm sorry, they're going to have 1.2 billion in higher interest payments on that debt. So we have to find out whether they're including that or not. They may be. That might be why you went from 2.3 to 1.3. You know, they may be including the interest, but these are all the questions you've got to ask. Have you taken into account the rising rates in your longer term projections? If they have, then God bless. Because if that's where they are with 5.5% interest, if that's their plan, then I don't mind this at all. And I will tell you that's probably the case because NLY, best management in the REIT industry. NLY, CIM, same management team, best in the industry. Those are the guys I always want to be in. The other guys, they can be iffy. And the trick is you've got to be able to understand what it is they're actually doing and make sure you're on board with their plan. Because that's what you are. You're an owner of this company. You got to make sure you understand what they're doing with your money and whether you want to hold on to it or not. Mitchell says, can you talk a little more about what's going on with Boeing and our options after this morning's earnings? Okay, so Boeing took a loss, BA. So Boeing took a loss of $1.2 billion, something like that, for the quarter, which is a lot of money. I don't know if they have quarterly estimates. Let's see if they probably do. Income statement, interim. No, they don't do estimated though. That's the problem. And it's not up to the date. See, last year Boeing did +1.4. They did +1.4, +2.4. That got wiped out by this, and +1.7. So they're about +3 billion for the year. Okay, coming off of this quarter, they were expected to be flat, and they lost $1.2 billion. But notice they're very capable of making 1.5 billion a quarter, and all of that is way low compared to the real potential for this company when they've had quarters where they've made $4 billion per quarter in gross profit. Even operating profit, though, $3 billion per quarter operating profit. So Boeing is capable of dropping $3 billion a quarter, 10 billion, 12 billion a year to the bottom line. Actually, let's go back to that. So they're not shooting for the stars here. And that's 2020. I'm sorry, this is 2022. So last year they had a net loss. Here they were showing 1.7. They were supposed to be flat. They lost 1.2. They may only make 500 million for the year, but it doesn't mean they're off track for next year, making 4.3 million. And you buy the whole company for 98 billion. So it's about 20 something times next year's earnings. And Boeing, the thing about Boeing is, oh, that's nasty too. They're down to 152. The thing about Boeing is, where are you going to go? It's Coke or Pepsi. You're going to get Boeing or Airbus. There really aren't other places to go to get planes. So they've got back orders of, I didn't remember the number, 100 and I want to say 130 billion. Boeing 160. They just reported they lost, and the money is being lost on supply chain. Now, you know, is BA, how many times I said, the problem BA is it's part of other words. Everybody's got a basic membership shows up. Huh. Oh, there it is. Okay. So 777 production is halted through 2023, but you know they passed it up. They took a $1.5 billion charge on the 777 delay, so it's not like they're going to do that twice. They doubled. They delivered. They're delivering 93 a month, and they were delivering 77 last year. So that's when you go back to look at the quarterly revenues. Oh, I'm sorry, $300 billion worth of planes on back order. That's the number I was looking for. So you have $300 billion worth of planes on back order, and their total annual amount is 80 billion. Not all of it is planes, but let's say 60 billion is planes. So they're about 5 years back ordered on planes, and more orders come in all the time. So it's not like that back order is going to get cleared out and that's the end of their business. But they're 5 years of back orders on planes. So as much as they can possibly make for 5 years, everybody wants. They're capable, when production is ramped up and everything is going smoothly, which it totally isn't right now, they're capable of making $10 billion. $10 billion against 98 billion in market cap is just plain stupid. So yeah, I want to be in Boeing for the next 10 years because they're going to make $100 billion over the next 10 years, barring any major catastrophe. But they'll make every penny of my money back over the next 10 years, and I'll still have the stock at the end. So yes, I do want to be in Boeing. And the question is, though, you have to be willing to stick it out. You have to be ready to get more, frankly, if it goes lower. And you know, our position, we don't have, do we have a position in Boeing? As far as I know, we don't have any right now. But we are going to initiate a position in Boeing, especially if they're going to drop to 150 frickin' dollars. You know, we're gonna take a position in Boeing. I thought we had it, but I looked and I said it's not in any of our portfolios that I see. So if anybody knows that we have it somewhere, please let me know. I didn't see it. I do want it. If we don't have it, I absolutely want it. And the way you do that is you say, okay, Boeing, 150 bucks. This is a stupid price. It can get stupider, but I can sell the 2024 140 puts for 22 bucks, right? So if we sell 10 of those, we promise to buy $140,000 worth of Boeing. And I sell 10 of those for 22 bucks. That's $22,000. And then we buy, I guess 140. We buy the, well, generally we buy the 140, and let's say that's 41. And let's say we buy the 140, 180. So that's 41 minus 23.50. Okay. So 41 minus 23.5 is 17.50. And what do we say we're going to get for these? 22, right? So let's say let's say we do 20 of those, so times 2,000. So we spend 35,000 there minus 22,000 for the short puts is 13,000. So selling 10 of the 140 puts and then buying 20 of the 140, 180, I think I said, right? 140, 180 bull call spreads. So 20 of those spreads is $80,000 if they pay off, because they'll pay off 40 bucks. So that's minus $80,000. So the upside is $67,000 divided by $13,000. So 515% upside potential with the, but then that's going with 20 of the, or 2 times whatever you sell the puts. Obviously you want to size it right for your portfolio. But in this case, selling, buying 20 of the 140, 180 bull call spreads and selling 10 of the $140 puts in 2024. And doing that, you can make up to $67,000 if Boeing can recover to 180 in the next 20 months. So that's the way you take advantage of it. Now, given that we're going to make 515%, I would rather wait and make sure Boeing finds a bottom, because if I make 300%, making the same bet after I see Boeing make a bottom and consolidate and look good, I'm fine making 300%. I don't need to make 500%, because they're currently distressed and people are freaking out. We can currently make 515%, probably 300 and something percent if we wait. I'm happy to wait. 300% is perfect. You know, it's like if we when you can take $100,000 and make $300,000 for betting on something where it's clearly bottomed out, that's a little bit nicer, right? And you know, we go back to really long shorts. I mean, we're getting into, where is this number? You know, this is 134. Okay, so down in this area over here is like 134 when the market's completely crashed. And don't forget, airlines were not flying during this time, and this is not a good chart. Okay, this one. Okay, so airlines weren't even flying, and they were holding $150. When travel was banned and we had no idea when it would start up again, and airlines were like possibly going bankrupt and canceling out the orders and so on and so forth, Boeing was worth $150 then. So when they're offering to you now for $150, when we already know that they're going to fly, the government's going to bail them out, is another thing. That's another thing about Boeing. It's Boeing. They can't let it die. You can't let the U.S. aircraft builder die. So they're too big to fail. They've got back orders up the ass, and we've already seen that people are going to travel whether there's COVID or not. Everybody will put their masks on and get on a plane anyway. How much? Oh, we were just looking at that chart, weren't we? This much. Yeah. But if they're flying half, the funny thing about the airlines though, they're flying half, but even when the planes are empty, they're still flying the same slots. They're still using the planes, using the miles, and so on and so forth. The airlines were taking a bath. And I'm sure if it continued, they would have cut back on their schedules, but they didn't. Government gave money, airlines lost a lot of money, so on and so forth, but they still need the planes, and they're still flying the planes. And now that they're coming back up, they need the fuel-efficient planes very badly that Boeing is making. They really need those. In fact, the whole saga of Boeing with the 737 MAX, the whole thing started because they tried to deliver a more fuel-efficient plane. And to make a more fuel-efficient plane, they pushed the wings forward on the aircraft, and pushing the wings forward saved them 15% of the fuel, but it also gave them a diving problem. And so the computer on the plane was supposed to correct for the diving problem, and instead it made it worse, and the two planes nosedived into the ground with people on them. So they have software now. They couldn't correct the design because the design is what makes it more fuel efficient. If they correct the design, they go back to having the old planes. That would have been a disaster. So they had to come up with a better software fix. That's all they did. They didn't change the body of the plane, which they should have done. They should have said, well, that doesn't work. You're not going to save fuel this way. It doesn't work. They refused to do that, and they came up with a software fix. So basically, don't think about it. I was going to say, I'm getting on a plane in a week, so don't think about it. If it only just 737 MAX, but those are going to be the only planes in the future. But you know, try not to dwell on the fact that like your entire flight safety is based on the coding of a software fix. It's very scary. So what is this? 2020 pre-COVID. Look at that. So for pre-COVID, we were heading for like a record year. I guess that's the. It's got. I hate when they have stars, but they don't actually tell you what the stars mean. Oh, I see. This figure was taken from previous edition, released prior to coronavirus. But how could it be 2020? I don't know. Forecast. Oh, there you go. 2 stars forecast. Thank you. All right. So this was the forecast for that year. That's what they were expecting before COVID hit. Then the actual for that year was here. So less than half. All right. But after 1 year of Corona, we were back to half. And now, as soon as they announce it's a little bit better, we're going back to 3.4. And next year, everything will be hunky dory again. But like I said, that doesn't really affect Boeing. In fact, nobody even stopped taking deliveries of the planes. It was Boeing's screw up with the 737 MAX that caused all the problems. So hopefully we're past that. Hopefully things will go okay. Hopefully Boeing planes won't jam into the ground and everybody will be happy. That is our basic plan going forward. So do we want Boeing? Yeah, of course. Whenever a blue chip company gets nailed like that, if they aren't dead, you got to get interested. And Boeing is just unique because it's the airline company for America. Europe has an airline company. It's not even like a country has to have an airline. Europe has an airline. Europe has Airbus. The whole European Union chipped in to have Airbus. We have Boeing, and it's all ours. And then the only other people making it is Embraer, really, is Brazil. But it's a joke. You can't even. It's a tiny percent market share. It's not even worth discussing, really. And then China's got some people making airplanes, and people don't want that. Russia, forget. So then nobody's jumping in and taking away this market share, unless Boeing themselves screw up beyond recognition. But Airbus tried. Airbus completely screwed up. Their A380s were a disaster, and they're already killing that program. Those jumbo A380s, which I said from day one when they announced the design of it, I said it was a disaster, and I said it was a disaster for a very simple reason. I'm like, where are you going to put it? What airports do you go to that are ready to take a plane like that, to have a 2-level plane disembarking in the lounges? Think about the disruption of that and the hassle and so on and so forth. And the problem is they asked their richest clients, and the Arab states were all like, sure, we'll build a special terminal for it and blah, blah, blah. Like, sure you will, but you're not freaking Newark. You can't get nothing done. You can't get Newark done. Heathrow's been trying to build another landing strip for like 10 years, can't get approvals going through. You're going to sit there and start messing around with terminals? TWA, they redesigned the old TWA terminal at LaGuardia. It's gorgeous. It's a hotel now. But that was a 10-year project. So you can't expect most airports to start making accommodations just to land your planes. And not only that, though, but the concept of those planes, which was like luxury air travel, have a bowling alley on the plane, have a movie theater on the plane, blah, blah, blah. It was obviously doomed to fail because all they did was put 500 seats in a single plane. They just like they do with every plane, right? They ultimately end up stripping out all the things that were supposed to be so nice, and they just shove more seats in. So who cares how big your plane is? And that wasn't the point of that plane. It was supposed to be for those super luxury flights from Dubai and whatever, and going out from the Arab republics and going to Japan, people flying, to compete with Singapore Airlines and things like that, where it's all about the service. And they wanted to have an airplane that would have 100 first-class seats. That was the point. The point was not to have a plane with 600 ordinary seats or whatever the number they managed to max out at. So that's where that all fell apart for Airbus, and they couldn't get the airports to go behind it because, again, Airbus was like, the airport's like, well, what's our incentive? Airbus should have put the money aside to get it done and to change the terminals, but they didn't do that. And they're basically saying, no, you have to spend $100 million, $200 million to redesign your terminal so that you can accommodate our planes. And since they're only long-haul international flights, you're only going to see like 4 a day. It makes no sense. There's no net benefit to the passengers, and most airports are municipal, and it matters as to what your net benefit is to the constituency. So that's where that all went south. Anyway, it's a tough business. So Boeing, they know what to do. They delivered exactly what people wanted, which was a plane that would get 15% better fuel efficiency, hold the same amount of people, have the same amount of range, and so on and so forth. They just said, hey, here you go, you do all this and save 15% on fuel. And the airline's like, oh, that's exactly what we need. And they got orders up the ass, but then it crashed. So they forgot one important component. It needs to get you from point A to point B without dying. Other than that, though, way better plane. Like much, very, very good seeing the market. And they got their 777. There was a story yesterday about the some Arab or some Saudi Arabian or something like that. The sheik ordered a plane, and they take 5 years to deliver. So he died before they delivered the plane. The plane was delivered, and the estate paid for it or whatever they did. Or maybe it was prepaid. Who knows with those guys? But so he gets this plane. It's like a $300 million plane. It's empty. It's cool. It's like an open 747 with nothing, 2 levels, empty, no seats, no nothing. And it's been sitting there for 5 years now, not being used. No one ever figured out to do anything with it. And now it's now because 747 is retired, they're actually like scrapping it without it ever. I think they said it flew 47 hours. The plane has only been flown 47 hours out of a usual 100,000 hour life cycle. That plane's been flown 47 hours and it's done for $300 million. So what does that work out to? It works out to something like 7.5 million dollars per hour of flight is what got burned on that thing. So don't complain about private jet fees. Right? Don't complain about your private jet fees because that guy broke the record. Anywho, so all right. Well, 1:45 already. See if there's any questions. So that's what we're looking for, these opportunities where we see earnings and we say, oh well, that's a one-time thing. That's not something they should be punished for at this level. Here, Diebold fell sharply. So you have to look at ones where you say, oh, that doesn't sound right. Generac. We love Generac, the generator company. And where are they? GNRC. So they got punished. Oh, they came back already. Okay. Absolutely want to get this in our portfolio. They look at that. I mean, look at the drop off here. They're down to $14.7 billion, and also another company with big back orders. They're making $700 million, so they're basically at 20 times earnings, but they got great growth. 2.4, 3.7, 5, right? Freaking great. 5.6. They're growing at an incredibly nice rate. And also, what do we know? What's the macro on them? The macro is that this is a company, and believe me, I know this from my house in Jersey. There's only so many times you lose power in natural disasters before you say, you know what, I'm getting a freaking generator. It's $3,000, and I won't be inconvenienced. Because where I lived, anytime we had a big storm, a power line would go down, right? Because we had the above ground power lines, and and where I lived, it was on a mountain, basically, not a big mountain, but a little mountain. But we lived on the first big mountain outside of New York City, and so we would get hit pretty hard by storms, and we had all these electric lines that were probably run in the early 1900s, and the problem is, because we had a lovely area, all trees and things like that, and all foresty and woody, and everything's great. But the problem is, all those forests and woods grow around all the lines, and then if a branch falls or breaks in a storm, it takes the lines down with it. even when they sway sometimes, if they get iced over. There's so many different reasons we would lose power. It would be like literally at least once a month, power would be lost. And, obviously me, I'm in the middle of doing this or something like that, and power would go out and would drive us crazy. So just so many times you get driven crazy before that happens. I'm in Florida now, and we get zapped out of the grid whenever there's a big lightning storm. They don't have above ground power lines, but what they do have, the underground lines, when there's a huge lightning strike, it pops everything off. Not, the breakers kick in, everything works, it comes back within a few minutes. But, that's freaking annoying too. And as the weather gets worse and conditions get worse, more and more people are exposed to this. And when you look at Generac's total sales of $5 billion, right? And you say they're $3,000 generators, so 5 billion divided by 3,000. So they're selling 1.6 million a year, but there's 110 million homes in America, and there's also obviously all those businesses, millions of businesses. So they are in no way, shape, or form saturating the market, and it's becoming more and more of a thing. So more and more people, how many people do you know who have whole home generators that kick on in the storm? But it's becoming a thing, and people are becoming much more aware of the fact. And realistically, I've got 2 UPSs. Both of these UPSs were like $500 UPSs. So I spent $1,000 just to put UPSs on my computers in my house that have maybe a 2-hour thing. These Generacs kick in for $3,000. Generac kicks in and completely can run your house. Everything stays on. Refrigerator stays on, everything. So it's to me, it's really they're going to grow as fast as they want to, and the climate isn't going to get any better. So there's many reasons to have it. Also, as you get more and more solar homes, you have to have something as a backup. If your solar kicks out, these guys run on gas or whatever. Gas like propane, natural gas. It'll run on whatever you need it to run on, and they're backups for like main house systems and things like that. So I think Generac has a really good future. I think they're very fairly priced right now. They're a healthy company, don't have much debt, and it's also a backlog of orders. So that's one I really want to get. Didn't know they were bouncing, but that's something somebody remind me about that, because we gotta put our bids in. GNRC. And they've been they're on our watch list. This is one of our watch list companies where I always said, if it gets cheaper, I want to buy it. It never got cheaper enough that we wanted to get in. But in fact, I'm sorry. I think I probably said if they get cheaper back here, and they kept going up and up and up. But now they come back to 200, and even though I wanted to get cheaper from 150, it came back to 200 now, and I'm like, oh shit. But they've grown tremendously, so I have to readjust my setting on that. I can't pretend they're going to get there. But it's the same thing. We're going to promise to buy them. You take advantage of the drop. So it's when it drops like that, there's always going to be people who bet it's going to drop further. Bah. So we go back to 2024. They're at 250 now, or 230 something, and we sell the look at this huge number. We can sell the 200 puts for what's that look like? $34. Let's say 34. So we sell the 200 puts for 34. That puts us in for net 166. So that would net us in for 166, which is tremendously low, about 30% lower than it is now. And let's say we only sell 5 of those. 5 of those at 34 is $17,000. And then we would pick up, let's see if we can do 10. Hopefully we can do 10. And then we pick up 10 of the, let's even look at the higher ones. We can go with the 250-300 spread. So the 250s are 56, let's say, minus the 300s, which are split the baby at 38. So minus 38. Well, that's only 18. So yeah, if we buy 20 of those, that's 36,000 minus, what did we say we were selling? 10 of these guys? Oh, that's crazy. See, we could sell 10 of the 200s for 34,000. That means we'd be in the whole spread for net. Wow, what a trade. That's a top trade. So it's a 250, 300 spread, and 20 of those is a $100,000 spread. And we're selling 10, half as many, of the 200 puts, and our net cost is going to be minus 34,000. Oh, I'm sorry. I was greedy. I started off with the. It's such a good trade. I'm willing to go higher. I started off saying it was going to be 5 and 10, but now it's like 10 and 20 because it's just too good. So we're committing to buying $200,000 worth of Generac stock, but we're only spending $2,000. So we're only going to be $2,000 over the 200,000 if we get assigned, and we'd own it at 200 is our worst case, which is still, more than 10%, 15% below where it is now. But our upside potential at 250, I'm sorry, not at 250, at 300 is $9,800. Now, what we want to see though is what if we instead were more conservative and took the 180 230 spread, and that's 65 and let's say 91. So 91 minus 65 is 26. So instead of spending 18, we'd spend 26. That's a lot more. I think on the whole, I'd rather have the 250, 300 because I have a lot of faith that they'll get to 300. So I think the 250, 300, and if it's not performing, we can always roll down and spend some money because we only spent 2,000 to get to that. So I would say that would be the plan. As I would say, as long as they're holding up around 235, I'm not worried, and I'll see them climb. If they don't climb by next quarter, we might start selling some short calls. We might roll it down a bit or so on and so forth. But that's, I think, a good spot to start the trade. And if you don't have obviously make sure you have room in your portfolio to double down if you have to, if it does really go down or something like that. But maybe we'll start with 10 because we'll see. I have to do the math, but it's just so cheap. When you're shooting to make 98,000 on 2,000, you have to really think like, I'm being a little greedy here. We need to maybe tone it down a little bit and not take so much risk and spend a little bit more cash to be in the position. Because there's nothing wrong with spending 20,000 to make 80,000, right? Which would be up 300%. You don't need to be up whatever the number is. 98 divided by 2 is 49. So 4,900. You don't need to be up 4,900% on the trade. Especially when you're making an aggressive target. So I'd rather take a look at some lower targets and see what we can stretch it out to. But that's interesting with Generac because they don't even go below 125 in their things. So the 150s are 105, let's say. Wait, 150? No, not 105. Sorry, let's say 110 for the 150s, and the 200s are 80. So that's $30. See, that's kind of attractive though, right? That's what you got to do. Is you got to see if you can find the right combination. Because the 150s, what do we say? 110 and 80 is $30. I didn't like net 26 on the other one, but now we're completely in the money. If you can be completely in the money, and that's $30. So then we'd be spending 2 times 30 is $60,000 minus the same $34,000 over here. So that's what I'm talking about. So now we're spending $26,000 on a $100,000 spread, $74,000 upside, a little more normal. But the great thing about it though is you're 100% in the money. The thing is though, then I say, oh, well, I don't need to be 100% in the money because it's so low right now. So that's how you have to do it. And that's how, when I come up with the spread and I decide what it's going to be, that's what I do. I look at all the different targets and try to figure out, like, well, based on where I think it's going to be versus versus where it is now and what's going to happen and how much time we have. I think 300 is a very achievable target. I don't think I'm being risky here at 300. So to me, to spend a lot of extra money to be in the 150, I don't know, what are we looking at, 150, 200? To be in the 150, 200 spread, that's kind of wasteful. That's just wasting the extra money we spent. The 200, 250, okay, that's fine. But the question is, how much more am I spending for that? Because I don't even feel much more secure. It's like I just really, really think we're on the right track with this one. And the nice thing about this is I'm not spending much money now. If we're right with our $2,000 net entry, then we're going to make $98,000. If I'm wrong, then we can spend the money to improve the strike position of the 250s. But let's say we spend $25 to roll down to the 200s. That would be $50,000 more. So we'd be in for $52,000, right? We already spent $2,000. We'd be in for $52,000, but now we have a 200, 300 spread, assuming that was worth anything. Again, it depends why we fell lower and why we're rolling and so on and so forth. But that's very possible that we may be willing to do that, because then we'd be in a $200,000 spread for $52,000, $148,000 upside, and at the same target, at the same $300 target we had before. So if, like right now, if it doesn't find a bottom, if it falls further, so on and so forth, then yeah. But once this thing's back over 250, and if it looks solid, I'm very gung-ho to be investing in that one. All right, so after 3 o'clock, I'm going to wrap it up now. I hope that was informative to you guys, and we will obviously review and protect on the short-term portfolio and just keep up with the market. And the market looks like, oh, no, it's pulling back again. How does, every time, YM. Oh no, rejected. So, things are not looking that great. So just keep up with those hedges. And we're not going to be adding too many longs, because look at what's going on right now, right? The most important thing is we fix what we already have and make sure that we're happy with where we are, and then we can add some longs. But it looks like Boeing and Generac are both going to be very important adds for us. All right, thanks everybody for coming, and we'll do it again next week.